This is a quick walkthrough of problem 9-18. Everything you see in a red bold font is given in the problem. We need to calculate net income under the absorption method and using variable costing. Let's begin by tracking our inventory levels. We're told that we have beginning inventory of 0 units. We produced 1,000 units, so goods available is 1,000 plus 0 is 1,000 available. If we sold 700, our ending inventory then is 1,000 minus 700, which is 300 units. And that's the same under both absorption and for variable costing. Our beginning inventory then for February is our ending for January, and we've got 800 plus 300, 1,100, 1,100 minus 800 sold gives us ending inventory of 300, and again we'll just pick that up for our beginning March, and we have units available in March of 1,550, and our ending inventory is 50 units. Let's go ahead now and look at some of the other information we have. We were told our total expected fixed manufacturing overhead is $400,000. Under absorption costing, that's going to become part of our cost per unit. Under variable costing, our fixed manufacturing overhead goes straight to the income statement as a period cost. We are also told that we are going to allocate our $400,000 in fixed manufacturing overhead. We're going to spread that over an estimated 1,000 units per month. That's our budgeted units per month. So we've got a cost per unit of $400 for fixed manufacturing overhead. Our total cost per unit then under absorption costing will be our variable cost of $900 plus our cost of $400 per unit, or $1,300. And again, that's going to be the same in both February, March also. We've got $400 per unit fixed, $1,300 variable. Our fixed cost per unit under variable is 0. And again, that's because our fixed cost flows directly to the income statement. So our cost per unit will be 0 fixed plus 900 variable, $900 per unit. Let's go ahead then and look at how much overhead we're going to apply. If we looked at our manufacturing overhead account, we're told that our actual fixed overhead will equal our budget. And our applied is going to be our $400 per unit multiplied by our units produced right up here. So units produced, 1,000 times $400 per unit. In the month of January, we will have nothing in terms of any over or under applied fixed manufacturing overhead. So our volume variance is 0. In the month of February, we will apply $320,000 in overhead. That's because, again, $400 per unit, and we produced 800 units. So in this case, our work in process is too low by $80,000. Our finished goods is too low by $80,000. So our cost of goods sold then will be too low by $80,000. And we're going to want to pick up that $80,000 volume variance as part of our cost of goods sold calculation. In the month of March, we have $400 per unit times 1,250. We will apply $500,000 in overhead. In this case, we applied $100,000 in overhead too much. Work in process is too high by 100. Finished goods is too high by 100,000, which means cost of goods sold will be too high by 100. So we're going to want to subtract that from our cost of goods sold. All right, sales. Sales is simply our selling price of $2,500 per unit times the number of units sold. That's going to be the same both in our absorption costing income statement and in our variable costing income statement. In terms of cost of goods sold, our cost of goods sold under absorption is going to be our units sold, 700, times our $1,300 per unit, 910. In February, it's going to be our 1,300 times 800. And then finally, in March, it's going to be our 1,300 times 1,500. Under variable costing, our cost per unit is only $900 per unit. So once again, we will take units sold times our cost per unit. And I'll drag that across. So next thing we need to pick up is our variable selling cost. We are told that it's $600 per unit sold. So equals 600 times our units sold. And I'll drag that across. And notice our variable cost per unit is the same under both absorption costing and in variable costing. Our fixed our fixed operating overhead, we're told, is 140, and that's going to be the same for both absorption and for variable. So notice our differences between the two. Under variable costing, our fixed manufacturing overhead goes straight to the income statement. Under absorption costing, our fixed manufacturing overhead gets assigned to our units. And so we have a higher per unit price, and then we also are going to end up with a volume variance that we need to adjust our cost of goods sold. So as the last step, we can calculate net income, sales, minus the sum of all of our costs. And we can copy that across, and then the same formulas for our variable costing income statement. Hope that clears things up. If you got questions on it, please don't hesitate to ask.